Welcome to Furniture Industry News. Today is Friday, August 7th, 2026, and thanks for joining us. Earlier this week on this show, we told you to back the tariff refunds out of a company's gross margin before you benchmark your own business against it. That was advice. This week, it is the whole story. Washington has handed back roughly $100 billion in tariff money, and that cash is now sitting inside furniture earnings reports in more than one line item at more than one company. Let's start there. Here is the number. The federal government has refunded about $100 billion, which is roughly 60% of the $165 billion it collected under tariffs imposed through the International Emergency Economic Powers Act. In February, the Supreme Court ruled that the law did not authorize the president to impose those tariffs. Ray Allegrezza, a longtime industry editor, argues that we have spent most of our attention on the politics of that ruling and skipped the part that actually matters to operators, which is the cash. So who gets it? This is the part worth writing down. The money generally flows to the importer of record, meaning the company named on the customs entry as having paid the duty. If you bought imported merchandise through a distributor, a wholesaler, or a domestic supplier, you do not automatically get anything, even if the tariff cost was clearly built into the price you paid. That line does not care who actually absorbed the expense. Two more things to know. Close to 2,000 importers have taken claims to the U.S. Court of International Trade, and Customs and Border Protection is running a broader refund process alongside those cases, so the money arrives in batches rather than all at once. And the tariff regime itself has not gone anywhere. Duties of 10 to 12.5% are in force under Section 301, and a separate 50% tariff on certain Canadian goods has been announced. Allegrezza's read is that this refund may be an intermission, not an ending. Here is the practical takeaway. Find out whether you are the importer of record on anything you brought in directly, because that status decides whether a check is coming. And assume the competitors who do qualify are about to have money that you do not, because unexpected liquidity funds inventory, product development, and advertising.
But if you are a retailer buying from manufacturers who did get refunds, do not read yourself as powerless here. Automatic is not the same as unavailable. A supplier that raised its prices because of tariffs and then quietly keeps that refund is making a decision its customers will eventually hear about. Retailers talk. Word moves through this industry faster than an invoice does, and the retailer is the one who decides what actually goes on the floor. There is no shortage of manufacturers competing for that space, and the larger a retailer gets, the more attractive it becomes to whoever is not currently getting the order. So the real question for a supplier is not whether it has to share the money, because it does not. The question is whether it wants to explain that choice later to a customer who has somewhere else to buy. Handled badly, a refund that was supposed to strengthen a balance sheet ends up handing business to a competitor. Now, let's look at where that money actually landed this week, starting with Bob's Discount Furniture. Bob's reported net revenues of $619.6 million for the quarter that ended June 28th, up 8.8% from $569.5 million a year ago. Net income was $57.8 million, or 43 cents per diluted share, up 64.1% from $35.2 million, or 31 cents per share. Comparable store sales rose 2.3%. The company opened 4 stores, bringing it to 218 stores in 27 states, with its first 4 Nashville area stores coming in the third quarter. On the tariff side, Bob's had $45.1 million in refunds approved during the quarter. Of that, $37.9 million ran through cost of sales against inventory it had already sold. $5.7 million reduced the value of inventory still on hand, and $1.5 million came in as interest income. There is another $41.9 million still sitting in receivables.
But the most useful thing in that report has nothing to do with tariffs. President and Chief Executive Bill Barton said the growth came from bigger tickets, and that those bigger tickets came from customers stepping up into the chain's better and best tiers. He said that has been noticeable for the past 4 or 5 quarters. A deep value operator running an everyday low-price model is telling you that trade-up selling is working on its floor. Trade-up is not a premium segment phenomenon. If it is happening at Bob's, it is available to you. One honest note on the growth. Comparable stores grew 2.3% against total revenue growth of 8.8%, so the store count is doing real work here. Barton says the long-term goal is 500 stores by 2035. Now go to the other end of the price ladder and you find the same shape. Our house posted net revenue of $385 million for the quarter, up 7.4%, with net income up 13.1% to $40 million. Gross margin dollars rose to $172 million, and inside that figure is $23.8 million of tariff recoveries. The number to actually watch at our house is written business. Comparable written sales rose 12.5%, while comparable delivered sales rose 4%. That means the order book is filling faster than the company is emptying it, which is exactly the backlog pattern we flagged on August 4th on the factory side. This time you are seeing it on a retail floor. That written number is a real demand signal, and it is the one worth benchmarking yourself against. The profit line is not, because a $23.8 million benefit is sitting inside a quarter that produced $40 million of net income. So two retailers, one deep value and one premium, both grew, and both booked 8-figure tariff refunds. That is the shape of this quarter. Now to the story that will get the most attention. Doug Berrigan, who owns 5% of Ethan Allen, has nominated 6 candidates to the company's board and published an open letter to shareholders. He compared the company to a melting ice cube and said melting ice cubes eventually disappear.
His central argument is a 20-year comparison. Ethan Allen's annual revenue was $1.066 billion in 2006, and it is $579 million in 2026. Over that same stretch, he points out that Williams-Sonoma grew from $3.73 billion to $7.81 billion. RH grew from $713 million to $3.44 billion. On governance, he notes that Farooq Kathwari is 82 and has served as both chairman and chief executive for 38 years, and that no succession plan has been made public. Bergeron frames his campaign as reinvestment rather than cost-cutting, pointing to the company's $187.5 million in cash and investments and its lack of debt as the funding source. He wrote that in an era when 3 out of 4 furniture purchases begin online, the company appears to view e-commerce as a threat rather than as central to growth. His slate leans heavily digital, drawn from Wayfair, Cherish, eBay, and Neiman Marcus. Ethan Allen confirmed it received the nominations and said its board will present its recommendation in the proxy statement. Here is why this matters beyond one company. A week ago on this show, we treated Ethan Allen's vertical integration as margin defense worth studying because it lifted full-year gross margin while sales fell. Bergeron's counterargument is that margin defense on a shrinking base is not a strategy. You do not have to pick a side to take the premise seriously. If 3 of 4 furniture purchases really do begin online, this proxy fight is just the public version of a question your own traffic data is already asking you. 2 quick reads on betting. Leggett & Platt reported second quarter net income of $47.1 million, or 33 cents per diluted share, on net sales down 6%. Chief Executive Carl Glassman put the U.S. mattress market's unit decline for the quarter at low double digits, which is no better than the first quarter. Meanwhile, Somni Group grew net income 12% to $110.9 million, even as its sales fell 3%. Units are shrinking while the survivors trade up and consolidate share.
2 things to act on there. Somni Group said it raised prices in both North America and international markets after the quarter closed, so your betting cost sheet is about to move. And on August 20th, Leggett shareholders vote on Somni Group's roughly $2.5 billion deal to buy the company, still expected to close by the end of the third quarter, with regulatory clearance the remaining gate. If that lands as guided, you will be negotiating 2027 betting programs with one counterparty instead of 2. On the manufacturing side, Smith Leonard reported that residential furniture orders totaled $2.36 billion in May, up 8% from a year ago and up 13% from April. Shipments did not keep pace, rising only 1%. Backlogs climbed about 5%, and factory and warehouse headcount was down 5% from a year ago. This is May data landing in August, so read it as confirmation rather than news, and what it confirms is that the order book is improving faster than the capacity to serve it. Demand is going into the queue, not into output. If you are writing fall business on domestic programs, your exposure is the promise date, not the price. Reconfirm lead times in writing before you sell against them. On freight, Drury's index rose 1% this week, reversing 3 straight weekly declines on trans-Pacific rate increases and congestion at Chinese ports. Talks to reopen the Strait of Hormuz advanced, with Iran saying it is close to an agreement with Oman, though details remain unsettled. Separately, the National Retail Federation's import forecast shows this year's peak appears to have arrived back in May, with volumes down year-over-year in both July and August. The front-loading that got everyone stocked before the new Section 301 duties is finished, so anything you reorder now arrives under the new rates, not on the pre-tariff cost basis sitting on your floor. Price your fourth quarter replenishment on what it will cost to replace the goods, not on what they cost you to buy.
3 fast ones to close. At QVC's US and HSN division, home was down 11.2%, but remained that division's largest category, and the company has cut its debt from $6.6 billion down to $1.325 billion as it approaches an exit from bankruptcy.
Natuzzi has consolidated production from 5 plants down to 2 and is moving its Natuzzi Editions lines for North America from Italy to Romania, with its 30-day average market capitalization now close to the New York Stock Exchange's delisting threshold. And Dorel Home shrank by nearly half on purpose, exiting categories and channels to focus on its profitable Costco business. That is your briefing. If you find this useful, consider subscribing so you get each episode as it publishes.